So let's continue our discussion of valuing bonds, and today we want to talk about corporate bonds. So with corporate bonds versus treasuries, last time we did treasuries. Treasuries are very straightforward because all you have to deal with is the yield, the current yield. With corporate bonds, we have the current yield or the risk-free rate, but you also have the spread. Let's look at a table of spreads. This is a few years old, but it still serves a good purpose. You're looking at corporate spreads. First of all, you have all these numbers in here, 35, 48, 56, 128. Those are basis points. Remember, to convert from basis points to a decimal, you divide by 10,000. So 128, you take 128 divided by 10,000, you get 0.0128. 150 divided by 10,000 is 0.015 or 1.5%. 76 divided by 10,000 is 0.0076. 76 basis points is 0.76% or 0.0076. So what we'll notice, first of all, credit ratings. You start with high quality AAA down the low medium quality. I don't have a low investment grade in here. And the first thing you notice as you go down in quality, spreads increase. So that makes sense. Riskier bonds that have bigger spreads. BBB bonds pay you 150. Remember on AAA, we said over 10 years, if you got 8 basis points a year, that should be enough to compensate you for risk. And you're not getting 8 basis points a year. You're getting 82 basis points a year. We don't need to divide by 10 here because you're going to get this 82 basis points every year as your spread. So you're getting paid 10 times more than what the average default was going to be. And then if you have the recovery, you only need, remember from last class, typical AAA bond, only 0.08 of them, 0.8% of them go into solvent over 10 years. You divide that by 10, so about 8 basis points a year is the average default of AAA bonds over 10 years. And then you say you recover half your money because you have the assets of the corporation. So you only need 4 basis points to compensate you for a AAA 10-year bond, and yet you're getting paid 82 basis points, so 20 times more than what you need. And we even saw that with the BBBs. We saw for 50 BBBs you need about 30 basis points a year to cover you for that risk, and instead you're getting 150, 158, even 210. So that's the first thing we notice is, credit spreads increase as you go down in ratings. They're also much higher than the average default, annual default rates, and minus the recovery rates. The other thing we're going to notice is what we call the term structure of credit spreads. You'll notice on any rating, as you go out in time, the spreads get wider. So let's look at single A. For 1 year, it's 66 basis points, but for 30 years, it's 127 basis points. So we know there's a term structured interest rates. Normally, short-term rates are lower than long-term rates. We saw that last week. The 10-year was yielding about 0.7%, but the 30-year was yielding about 1.5%. So there tends to be a term structure of interest rates. There's also a term structure of credit spreads. The term structure with interest rates has several theories behind it that you should have seen in 3013, the expectation theory, the liquidity preference theory. There's several theories on why the yield curve is upward sloping. Why are corporate spreads? Why is there a term structure there? Why do they go up with time? Part of it just makes sense that it's much riskier. BBB bond, it's going to be much riskier to loan someone money for 30 years than it's going to be to loan them money for 1 year. So as a result, you have to pay them more. So this is probably a risk premium related to time, the term structure. When you see term structure, we're talking about how things play out at different maturities. So there's a term structured interest rates, a term structure to credit spreads, and it's very pronounced here. Sometimes the term structure of interest rates, the yield curve can be flat or even negatively sloped, where your shorter term rates are higher than longer term rates. That's usually going into a recession. I doubt you'll ever see corporate spreads having a negative slope. Longer term will always have higher. Now I don't know that for sure. I haven't looked at this every single year, but longer term bonds should have higher spreads than shorter term bonds just because of the aspect of risk. All right, so given that, let's value a treasury bond. You're going to notice it's the exact same thing we did last week. It's really not that much more more bells and whistles other than we got to add this spread into it. So let's go back to the spreadsheet we had last time. So last time we had a 30-year treasury. So what I'm going to do is I'm going to do our first corporate bond. We're going to do a couple of these. Corporate bond 1. And so we're going to make this a little bit more involved. Let's do a 30-year corporate corporate bond issued 20 years ago. At issuance, it was rated AA. Today, it's rated BBB. All right. So you have to ask, what is this bond? Is it a 30-year bond or is it a 10-year bond? Is it a AA bond or is it a BBB bond? So I'll give you a table, and let's just look at the table. Let's take first the risk-free rate. So we'll do current yields, and we'll do it for 30-year treasuries. Well, let me do it in order. 10-year treasuries and 30-year treasuries. So if we do that, so you should already know which is the correct column, but still just to make sure you know, I'll try to trick you a little bit. So let's say 10 years is 80 basis points and 30 years is 1.6. I'm not going to look up current rates today, but we know it's somewhere in that ballpark. And then we'll do spreads. So we can do spreads for 10-year, spreads for 30-year. We can do spreads for AA and spreads for BBB. So let's say 10-year treasury spreads today are, let's say, 70 and 130. And let's say BBB is 200 and 310. Right, I don't know what they actually are. It's really actually kind of difficult to get current spreads. Capital IQ might have that information. Bloomberg does have it, but it's not easy to get that data. All right, so there's our information. So the question is, which of these numbers do we need? So it's a 30-year bond, but it was a 30-year bond when it was issued 20 years ago. So what is it now? Now it is a 10-year bond. So our risk-free rate is going to be 80 basis points. Is 80 basis points, and our spread at issuance is AAA. It's a AA bond. Today it's a BBB bond. So we know we only care about what it is today. So our spread is going to be 200 basis points. All right. Let's say the coupon. Who knows? Let's say the coupon was 5%. Remember 20 years ago yesterday I said that was about 4.5% risk-free rate, and the spread was probably 50 or so basis points back then, so we used 5%. All right, so let's get the discount rate. So now to get the discount rate, we have to have two pieces. We need the risk-free rate and we need the spread. So the risk-free rate is 0.008 and the spread is 200 divided by 10,000. And it gives us 2%. And so our discount rate is just going to be 80 basis point plus 200. It's the risk-free rate plus the spread. The risk-free rate, since it's a 10-year bond, use a 10-year treasury. The spread, because again it's a 10-year bond and it's BBB rated today, we use 200 basis points. So that gives us the discount rate. After this point, everything's exactly the same as we did last time. So you might want to hit pause right here and finish the rest of the spreadsheet off the top of your head without referencing the notes or the previous way we did this. You should, as a finance major especially, or an accounting major should be able to do this as well. If you're a marketing major, maybe you're a little bit off the hook, but I would still learn it. But you should be able to do this off the top of your heads. So if you want to pause and work it. All right, so now I'm going to work through this. The first thing we need is the effective yield. The effective yield formula is exactly the same. It doesn't change just because we're doing a corporate. So we take 1 plus discount rate divided by 2, raised to the second power minus 1 because we pay coupons twice a year. So that gives us 282 versus 280. We're going to do our estimate. So I'm going to guess the duration for this is probably going to be, let's say, 8.9 years. I have no idea really. I know it's going to be in the 8.5 to 9.5 range. I'm pretty sure, but we'll see. So we want to take minus duration times the change in yield. So in this case, it's going to be minus 8.9 times our current yield is 2.8 minus the starting yield of 5%. So that should give us our numbers. So minus 8.9 times 0.028 minus 0.05. And we get that this bond should be trading at a premium of 19.58. Now you say, how in the world is that possible? It used to be a AA bond, now it's BBB. How can its price be higher? Well, its spread is much wider, but real rates are so much lower that the drop in real rates is more than offset the widening of spreads. You would have been better off having bought a 30-year treasury back then. It'd be much more up in price, but still, you know, you're still getting appreciation. So $1,000 times 1 plus that gives me $1195.80. So that's going to be my guesstimate. So we'll see how well that guesstimate does. Then we'll use the long formula. Again, let's see if I can do it on the first try. So what's our coupon going to be? The coupon, remember, is the coupon percent, 5%, times $1,000 divided by 2, or $25 every 6 months. So there's my coupon in dollars. Here's my coupon in percent. So the long formula, I'm going to take $25 divided by 0.028 divided by 2. Remember, that gives us that $25 for infinity every 6 months. Plus, we get our $1,000, but we got to subtract the $25 divided by 0.028 divided by 2 because we're not going to get that for infinity. So we're going to take the $1,000 minus that, and we're going to divide all of that by 1 plus 0.028 divided by 2, raised to, well, in this case, the bond has 10 years left, so our N is 20 because we're getting paid every 6 months. So hit enter, and I get 1190.73. That sounds like that could be the right answer. It doesn't look like I have any typos. My estimate was a little bit higher than that, but that's fine. And then the last one, the one you have to do, is the discount table. So we have time, we have the cash flow, the discount factor, and the discounted cash flows. So let's get all that set up. So we have 10 years left. We'll start in 6 months, and we'll add 6 months all the way through and go out 10 years. So there's our 10 years. What is our cash flow? Again, the coupon is $25, so 0.05 times 1,000 divided by 2, so there's our $25. We get that every 6 months with the exception of the very, very last time. And we, at the very end, we get our $1,000 back. So you'll always do it like this. We always assume $1,000. Our discount factor, this is the only time we'll use that effective yield, is 1 divided by 1 plus the effective yield. Lock it in. raise the 0.5 times and go out 4 decimal places, you know it's going to be 0.99 something or 0.98 something. Copy that down. There we have it. So our discounted cash flows, we just take $25 times our discount factor. Copy that down. And that gives us a price. And just the sum of those discounted cash flows. $11.90.73. $11.90.73, the exact same thing we got through the long formula. And so there's the final answer. How far off was my duration calculation? Wasn't off by much, 0.43%. So it was pretty close. But so you don't have to do this on the exam, although if you want to, it's perfectly fine. But let's do the duration calc. Again, we're doing Macaulay duration. So all you got to do is take the time times the discounted cash flow divided by the sum of the discounted cash flows. And you copy that down. So it gets me duration, just the sum of those discounted. Oh man, I was way off, wasn't I? I don't know why I thought it was between 8.5 and 9.5. Sometimes when rates are so low, boy, it's really hard to guess here. We got much higher with the treasuries, like 8.5, 8.6, but its discount rate was much lower. If you think about it, the higher the discount rate, the shorter the duration. That's a good skill to have. And that's because when you have a higher discount rate, it really weakens that 10th year, which is where most of your weight is, because that's when you get your $1,000 back. So when you have a higher discount rate, it reduces that weight of the 10 years. And since the 10th year doesn't have as much weight, you push the duration closer in. When interest rates are low, you get a much higher duration. That's why on the Treasury, our duration was 8.47, but that's because our discount rate was much lower. It's 0.79. So I've forgotten it was that low. I was thinking it was 8.8 or something. That's why I thought it was between 8.5 and 9.5. So between 8 and 9, it would be good to actually practice this and get some sense of what duration is under different interest rate environments. But to me, it's hard to just guess on the top of my head what that answer will be. So anyway, there's our valuation. There's our duration. Let's see how well the duration formula does if we use, instead of using 8.9, we instead use 8.19. We get a much lower number, but it's much further away. So actually my 8.5 or whatever I was saying, 8.9 was actually a better estimate on the price because we were closer there. But that's because of that convexity and all those other things. So there's a lot of things going on. So remember, duration is just an approximation, but that's a pretty good approximation. 11.80 and the bond price is actually 11.90. You're less than 1% off, so it's a pretty close approximation. If we put convexity in there, we'd probably get within 0.2 or 0.3%. So think about what we did. Real important, figure out what kind of bond is it. If I throw all this extra information in, it's a 30-year bond issued 20 years ago. At issuance, it was AA. None of that matters. All you care is that it's a 10-year bond today. Let me correct today. So it's a 10-year bond rated BBB. That's all we care about. I mean, it's nice. It's interesting. It was AA when it's at issuance, and today it is BBB rated. That means obviously some bad stuff has happened to this company, but it's all we care about as far as giving a price is that it's a 10-year bond rated BBB. That's what it is today. Its history does not matter to the valuation. It's just interesting to what's going on with the company that's issued this bond. So there's our duration. Now, interesting about duration is, if you think about it, it's a little bit tricky because the duration here is you have two pieces. You have the risk-free rate and you have the spread. So we talked about this early on in the semester, but just a reminder of this. Usually when the risk-free rate falls, usually spreads are widening. Why is that? Because rates fall in a recession. So if you think about it in that standpoint, corporate bonds will definitely underperform treasuries, because while the risk-free rate's falling the same for corporate bonds and treasuries, corporate bonds price won't go up as much because their spreads are widening, and with their spreads widening, interest rates won't fall, their discount rate won't fall as much. The risk-free rate might fall, spreads will widen, so the actual discount rate will only fall a little bit. So there's one scenario. Another scenario could be in a strong economy, risk-free rate rises, usually spreads are narrowing. This is a strong economy. So in that case, corporates are going to materially outperform treasuries. Some of y'all are really having questions on the practice exam problem we had for exam 1 on the tactical allocation, because I had a scenario where the economy was strong and interest rates were falling. That's a pretty unusual scenario, and people are saying, well, do I buy treasuries or not? Well, no, you want to buy the corporate bonds or the municipals because, yeah, the risk-free rate's falling, but spreads are also narrowing, so that's going to really decrease that discount rate even more. Now, you could have the risk-free rate rising and spreads widening. This is the scenario of 1970s stagflation. We had inflation but a weak economy. That's definitely a horrible play for corporate bonds. Treasuries will do badly as well because interest rates are rising, but they won't do as badly as corporates, because corporates, you got the risk-free rate rising and spreads widening, so your discount rate's going up a bunch. And then you have the one where I did an example problem, risk-free rate falling. Wait, I take the word usually out of here. I'll put but just so you can know it's unusual. So risk-free rate falls, but spreads are narrowing. That's the example I gave for the exam 1 practice problem. So this is the 1980s, strong economy with inflation being controlled. Yeah, in that case, we have a strong economy, but interest rates are falling because of inflation. So you see the two unusual periods where rates rise and spreads widen, or rates fall and spreads narrow. That really is an inflation-driven type of market. So those are fairly unusual. We're in this last one here where rates are falling and the economy is doing well, and that's, who knows what's going on. It's really maybe more the Fed action than anything else. So the question is, so you have two things going on. So the duration is impacted by both the risk-free rate implications and spread changes. So there's a new term that's come up. If you want something to Google, get more into this, because this is a really fascinating topic. A new term has come up. So we were talking about Macaulay Duration, and then modified duration, which modified duration is just Macaulay with a minor adjustment. We haven't talked as much about effective duration. That's something you could Google. Effective duration is for things like mortgage-backed securities and callable bonds, where you're not really sure what the cash flows are because people can refinance or they can pay off the debt early. So then you have to do a more statistical analysis, which is called effective duration, which is looking at the change in the bond price, running simulations, and looking at small changes in interest rates. But the last thing you could actually think about, and this is a new term. This is a term that was not in play when I was in finance. I don't fully grasp its significance. I see articles that say it's really, really important, but I don't see its importance. But it's called spread duration. And that's the impact on their corporate bond price. Obviously, treasuries have zero spread duration because they have no spreads. They are the risk-free rate, so there is no spread. But essentially, you're trying to find what is the impact on a bond's price given changes in spread. So it's an interesting concept. The reason I'm not so convinced it's all that important is if the risk-free rate rises 50 basis points, or if spreads widen 50 basis points, it should give you the same impact on the price. So I'm not really making the distinction, but it is a term and it's out there. So if you go out and Google spread duration, articles will come up. So here's an article that came up, Spread Duration, a new tool for bond portfolio management. It says a new tool. I don't know when this article was published. It says 1990s, so obviously I wasn't paying attention, but I was not familiar with spread duration until after I retired. So it may have been out there. Measuring the sensitivity of a bond's return to spread changes. Why is that different than the risk-free rate changes? And that's the part I don't understand. So I should read this article. Martin Leibowitz is a very famous person in finance, no question. I don't know these other two writers. Very famous guy in finance. You know, you might be able to get this article and actually read it. I just found it by just doing spread duration. They're not letting me bring in the whole article without paying them money. So it was in the journal of Portfolio Management. I usually read the Financial Analyst Journal. The Journal of Portfolio Management is a really technical periodical magazine. It's very advanced articles. But if you can get your hands on it, I'd recommend you get your hands on it and read some of the articles. Some of them are probably going to be a little complex. This article doesn't look all that complex or all that difficult. So you get the first page. If you want more, you have to register. I don't know if registration costs anything. This is a jpmorganresearch.com, so it might be free to register. Looks like they have some really great articles. So, you know, there's articles out there on this topic. You look, I just Googled spread duration. You can see all kinds of things come up. There's a Neuberger Berman, great firm for fixed income, so they obviously have something good to say about it. So they have a glossary of terms. That's pretty cool. And you can go to the S's and look for spread duration, the sensitivity of the price of a security to changes in its credit spread. The credit spread is the difference between the yield of a security and the yield of the benchmark rate. So it's essentially the securities yield minus the government bond yield of the same maturity. So there's a definition. Man, this is great. Looks like a great glossary here. So y'all should, you know, get link in, make it one of your favorites. Looks pretty good. In fact, right there, the very first thing on their glossary is ABS, asset-backed security. If you go to asset-backed security, just like we talked about, a security is backed by a loan, lease, or receivable against assets other than real estate or mortgage-backed security. So essentially what they're saying is mortgage-backed securities are a special type of asset-backed securities, so it's not in that category. I consider mortgage-backs to be an asset class, asset-backed security. But all kinds of terms in here, so that looks like a great website right there. There's a lot of others. Why is duration not the same as spread duration for risky assets? That's my question. So I should go read that one. This one's more of a, you know, you ask a question. So why do we care what contributed to change in that yield? The price sensitivity be the same regardless. If you consider a fixed bond rate, the IR duration and spread duration have the same effect on the bond. For a floating rate bond, on the other side, you have an IR risk only. So, I mean, they sound like it only really applies to certain types of bonds. That kind of makes sense to me. But still, you say if it's a floating rate bond, its duration is 0 because it's floating rate, but it has a spread duration. So yeah, I can kind of see that point. But anyways, it's beyond that, I can't see why it really matters. Here they say you care because you can hedge the risk of the bonds separately. All right. So let's do another corporate bond. So you've got a corporate bond here to practice. Let's practice one more time. This is one I would definitely say at this point, you can't do this without watching me. You're in trouble. Your Excel skills and your bond skills are not where they need to be. That doesn't mean it's hopeless. You can definitely catch up, but you need to get much stronger in this, especially on the Excel. If you find I'm going too fast in Excel, you're definitely behind the curve, because my Excel skills are not that great. I've really slowed down because I don't use Excel as much as I used to. I used to use Excel 20, 30 hours a week in my job building models all the time. I just don't do that much anymore. So I'm not fast. So if you think I'm fast in Excel, your skills are not where they need to be. And if you can't price a bond like this, then your finance skills aren't where they need to be. You need to get caught up, practice this, and do it over and over again. Practice these bonds over again. Find other examples. You can set up your own example and price it. And then I gave you that spreadsheet that allows you to price bonds, so you can actually go in and do it yourself on that spreadsheet to check your work after you built it yourself here. But you should be able to do this. But I'm going to build it again. So once I give you the problem, I'll pause for a second, and you can go work it yourself, and then you can watch me give the answer. So let's do a 30-year corporate bond issued 25 years ago. All right. At issuance, it was a AAA bond. Today is a single B bond. I want to show you the first discount bond I can show you. So let me give you some spreads. Let's do treasuries. We'll do the 5-year treasury. And we'll do the 30-year treasury. So the 5-year treasury, let's say that's 0.04%, and the 30-year, let's see, that's 1.8%. And then we'll do spreads. We'll do AAA spreads and single B spreads for 5-year bonds. Let's say they're 30. For 30-year bonds, let's say they're 80. For single B, let's say it's 950. For 30 years, let's say it's 1200. So there's my spreads. Those spreads are probably a little too much for triple B, but that's okay. We'll keep them there. All right, so the question is, what is this bond? So you already know it's a 30-year bond, but that was 25 years ago. So now it is a 5-year bond. And today it is a single B bond. So our risk-free rate is going to be 40 basis points, and our spread is going to be 950. Our coupon, let's say our coupon is 0.07 or 0.065. All right, so you've got everything you need. So if you want to hit pause and work the problem, do that right now. All right, so let's get our discount rate. A discount rate is going to be the risk-free rate. So our risk-free rate is 0.004 because it's a 5-year bond. And our spread is going to be 950 divided by 10,000, or 9.5%. And so our discount rate, we just add those two together, almost 10%. Obviously a very, very risky bond. And then our effective yield is going to be much higher, because when you get higher interest rates, the effective yield will be much higher than the discount rate. So we take 1 plus 9.5 divided by 2, raised to the second, minus 1. And that puts us over 10%, because that's a pretty big impact. All right, so first thing I'm going to do is I'm going to guess. I'm going to say my duration. I'm going to guess my duration. That's a pretty high rate. I'm going to say 4 years. It's my duration guess. Let's see how close I get on that. And so my guess is going to be minus duration times the change in yield. And that's going to be equal minus 4 times where our yield today is 0.099. It started off at 6.5%. So this bond is actually going to lose value. So minus 4 times 0.099 minus 0.065. This bond is expected to be priced at a discount. Remember, this is a discount bond. All the other bonds we did were premium bonds because interest rates are so low. So this is a discount bond. Why? Because its current discount rate is much higher than the coupon. So you have to give up some on price. So if we take $1,000 times 1 plus that, our estimate for this bond price is $864 exactly. So now we'll use the long formula. We can do that just like we did with the treasuries. So what is our coupon? Our coupon is going to be 6.5% times $1,000 divided by 2. So every 6 months we'll get $32.50. So to get the long formula, I'll do $32.50 divided by 0.099 divided by 2. We've been doing that over and over again. Plus $1,000 minus 32.5 divided by 0.099 divided by 2. And we'll take all of that and divide it by 1 plus 0.099 divided by 2 raised to, it's a 5-year bond, right? But there's payments twice a year, so raised to the 10th. And we get 868. That looks like that could be the right answer. Awfully close to our estimate. See how much confidence it gives you to know these other approaches. And so now we'll do the discount table. So we want time, we want the cash flows, the discount factor, the discounted cash flows, and you know I'm going to do duration. Just out of curiosity, I just can't help it. So we'll add that later though. So again, it's a 10-year bond, so we start off in 6 months, which is half a year. We add half a year until we go out till year 5. What are my cash flows? As we said before, it's 0.065 times $1,000 divided by 2. So $32.50. And so we'll copy that down. We know the very last times when we get our $1,000 back. Hopefully you do. This is a single B rated bond. So you've got about, you've probably got a 10-15% chance it's going to default. So hopefully you get your money at the end. Our discount factor, no difference here. We take 1 divided by 1 plus our effective yield raised to the time. We copy that down. You notice that it's no longer 0.99. It gets much higher discount rate. So we take the cash flows times discount factor, and that gives us the discounted cash flow. And so that gives us a price of $868.41, exactly what we got before. That gives me a lot of confidence there. How far off was my estimate? I mean, let's say that you did this for your boss. Off the top of your head, your boss says, what do you think that bond's trading for? You go, it's probably about $864. And you do the math and it's $868. Your boss will be pretty impressed. That's a good estimate. Let's see how much we're off because of the duration calc being off. So again, we'll take time times the discounted cash flow divided by the sum of the discounted cash flows. I'll copy that down. Now this bond has a very, very, very high discount rate. And since it has a very high discount rate, remember that means it's really going to reduce the weight of that final cash flow. So it's going to greatly shorten the duration. That's the reason I went to 4 years in my estimate. But actual duration, looks like I'm off. It's a little bit higher than I thought, but 4.29 years. If we use the 4.29, what would that have done to my estimate? 854 would have been even further off if I had the correct, one, but still I'm within 2% or so, so it wasn't too far off. It gets a little tougher when interest rates get really high like that for my brain to figure out exactly what the duration might be. So there's the second corporate bond, a 5-year corporate bond. So again, what do we know? It's a 30-year bond, but it was issued 25 years ago. So all we care about is how much time is left. There's only 5 years left. All we care about is what its rating is today. It's single B today. Our discount rate will all be based on 5 years in the current rating. We add those together. We get our effective yield just like we did before. Divide by 2, raise it a second. That's always the case with corporates and treasuries. We use the long formula. We use the table. Got the exact same price doing that. We estimated it using our estimate of duration. And there's our answer. This is what, so the green is what you have to have on the exam. So the green's required on the exam. Everything else is optional. All these other things, I mean, that's not optional, but you have to get all of that. So if you want to do the long formula, if you want to do the estimate, I highly recommend it. Now you are going to be time crunched on the final, so maybe you can make an argument that, you know what, I'll just skip doing those. But why not set it up? The nice thing about the long formula, if you look here, I could have done this mathematically. I had it set up as a formula. So if you do that, that gives you some advantage. So you take 3250 divided by the discount rate divided by 2. Remember, use a discount rate and not the effective yield. Plus $1,000 minus the exact same thing again. Coupon divided by the discount rate divided by 2. Divide all of that by 1 plus, again, the discount rate, not the effective yield, divided by 2. Raised to, now here I don't have the 5 years anywhere, so there I'll just have to type that in. But if you wanted to say the term and say it's 5 years, then you have everything in the formula that you need. Then you would just do 5 years to maturity times 2, and there's that 868.41. So you could actually even set that up so you'd have that check there, and you could set the duration up. What's your estimate on duration? So you just do minus duration times the current yield minus the coupon, which is, I'm assuming, is the starting yield. When you do that, you get your estimate, and then you get the actual duration over here. If you wanted to, you could certainly go that far. I'd be really impressed. Obviously, impressing your professors is a good thing to do because you may need someone to be a reference for you for a job. It's best to ask professors to do that are impressed by you, not ones where you never tried all this kind of stuff. So some students are going to be, why would I do all of this? But it's a waste of time. Those are students who probably shouldn't be in investment management. They may be good for finance, but this is not their thing. Some students are like, wow, this is cool. I want to practice this until I become perfect at it. That tells you you're in the right career. I find this stuff fascinating. I love building this kind of stuff and just testing my knowledge. That's one of the reasons I had to do the duration calc, is I wanted to see how far off my 4 years was, just out of pure curiosity. I forget on the Treasury, its duration was 448, so I knew it was lower than the Treasury because the yield is higher. But I'm not, you can tell I'm not that good at just top of my head coming up with the accurate duration. I'm usually off a good 5% or more. All right, so that gives you a lot of practice. That's all we're going to do on bonds. There are other bonds out there you can practice with, other examples I've given you, but you can do it yourself. So if you think about this spreadsheet I gave you, this is the duration and convexity calculator. You can create your own bonds up here. So here this has the coupon and the yield. For the yield, you'd have to include, in our case, we said it was a 5-year bond. Its coupon was 6.5%. Its yield was 9.9. And we got that 868.41. So you could use this. You could create all kinds of bonds that you want to practice on. There's my effective yield. That's in there. Here's my convexity, 2251. My duration here is 409. Remember, duration is going to be lower because I'm dividing by 1 plus the current yield divided by 2. That's how you get from Macaulay duration to modified duration. So in this case, the actual duration, the modified duration, is much, much lower because the discount rate's so high. And since I'm dividing by 1 plus the discount rate divided by 2, that definitely influences how much that modified duration will be lower than Macaulay duration. So where have we been here? So I'm giving you some terms. I've given you several terms you could look at. We just said that the duration formula we are using, this formula I've given you over here, where you just take the weighted average time maturity, that's known as Macaulay duration, which I'm not 100% sure I'm spelling it correctly. I've just now told you that Macaulay duration can give you modified duration. Modified duration is the more accurate number. It's Macaulay duration divided by 1 plus the current yield divided by 2. That's because cash flows come in twice a year. I showed you that in the other spreadsheet. Shows you that here. This sum here that I'm doing in the spreadsheet is doing exactly what we did with modified duration, and I'm divided by 1 plus the yield divided by. So that's modified duration. Effective duration, you could certainly look that up, and that is a stochastic process. That's simulation for complex bonds like mortgage-backed securities that we've talked so much about, those bonds that have those embedded options. You can't just use the formula like we did for duration. Why? Well, because we don't know what cash flows we're going to get. You might have refinancing, you may have people extending, so that gets pretty tough. It's effective duration. We talked about spread duration. You can certainly look that up. I'm not convinced it tells you a whole lot of new information, except for in very specific cases where either a floating rate debt, as they showed in that one article, or maybe when it comes to hedging a particular risk, maybe you want to break out the duration between the interest rate duration and the spread duration, because you only want to hedge one of the two risks. Maybe you want to hedge the spread duration using credit default swaps or something like that. So there's different terms that you can all look up in. This is the quant of fixed income. It also includes things like interest rate theory, and there's a lot to interest rate theory. You'll get these things called arbitrage free modeling. There's all kinds of stuff. Some of this is probably over my head because I haven't seen it in years. Actuaries do a lot of this. If you get into this, it gets quite complex pretty fast. So how could you start working on something like this? If you take the CFA exam, part 2 is pretty heavy on fixed income. I still remember a question they asked on part 2 was about a mortgage-backed security, specifically a Ginnie Mae bond. And I had memorized the Black-Scholes option pricing model formula, so I was actually able to put that into that problem to talk about the importance of interest rate volatility. There's a lot going on. So CFA exam, the Bloomberg machines in the FSC, if you can get back on campus, they have a lot of fixed income modeling, and you can certainly just click on the mortgage button or on the corporate button and just see what they have there. You could even do a search. They have a very good search function. There are a lot of models for fixed income on Bloomberg. And then you can buy Fabozzi's handbook of fixed income. It's a little expensive and it's pretty long. They have used that on a CFA exam in the past. Here it is right now. You can see it's pretty expensive. You don't necessarily have to buy the latest edition. Getting an edition, even the used ones are pretty expensive. So a later edition might be all right. I don't know what edition this one is. But if you look in it, this is a good time for us to look for Bosey, see how much of this stuff we recognize. So he starts off, he talks about the features of fixed income securities, bonds, preferred stocks. Remember I said earlier, preferred stocks are part of bonds. They're not considered stocks, they're considered bonds. Mortgage-backed securities, whether residential or commercial. Asset-backed, see how they separate mortgage-backed from asset-backed. I consider them all part of the same thing. We didn't get much in the covered bonds at all, but and then they do the risk. So this is what we've been talking about here. Remember we talked about interest rate risk, that's price risk. That's what duration measures. We also talked about reinvestment risk. We don't have a really good measure for reinvestment risk. We talked about call and prepayment risk on those bonds that have embedded options. We definitely talked about credit risk. If you think about it, this is DC cut size. There's the DCC. There's the I. There's the S. There's the U. I mean, there's the DC cut size is almost completely there. They don't have the tax versus taxable, but I'm sure it's in here pretty quick. They definitely have a section on municipal bonds in here. So everything of the DC cuts I is in there in this book somewhere, but almost all of it's under here on risk, and that's really what the DC cuts I is. It's how do we measure and manage risk with bonds, whether it's interest rate risk where we use duration, call prepayment risk where we use convexity, credit risk, inflation risk, and purchasing power risk, liquidity risk where we have those structured bonds that aren't very liquid so they pay us an extra return, non-US bonds which have a lot of currency risk, exchange rate risk. Volatility risk to me is, that's just the prices, which is the combination of all these other things. Political risk, obviously, if you're buying non-US bonds. Legal risk. Event risk is a lot like credit risk, is that just something happens. Sector risk, we talked about event risk and sector risk. They really belong under credit risk. So here they talk about standard deviation, skewness, kurtosis. Obviously, bonds are very skewed because you have very limited upside and very large downside. But a lot of stuff we talked about is in here. They go into the major bond indices. We do not talk about those, but there are bond indices like the Merrill Lynch, and the Barclays aggregates. It used to be the Lehman aggregate, but now it's the Barclay aggregate. Trading fixed income, just some gee whiz numbers about what's going on technology-wise and market size. There's definitely on fixed income. What I think on fixed income, I've had a few students in this class express a lot of interest on the economic side. And if you really, really love economics, fixed income is a great place to go. You're very much concerned about government policy, about Fed policy especially, the overall economy. So those are important things like yield curves and spread curves. We just talked about the spread curve. Remember we talked about term structure of spread curves, what the Federal Reserve is doing. You talked about some of that in your first paper. So there's a lot of stuff we're doing in this class that's hinted at, but you can tell, there's a lot more that you could do. Stagflation, we mentioned. And then pricing and yields, bond pricing, we just did that. Conventional yield measures, we talked about yield to maturity and effective yield. Total return analysis, we haven't gotten into that at all in this class. We really don't get it in this class at all. Measuring interest rate risk, obviously you got duration, modified duration. There's your effective duration right there. There's your convexity. The price value of basis points, that's kind of what effective duration is doing, is how much does 1 basis point change in the yield impact the price. Structure of interest rates, you definitely have to understand that, the term structure of interest rates. Why are interest rates like they are? What does it tell you about recessions and Fed policies and those kind of things? So we're covering a big chunk of this book, but at an extremely high level. So if you really want to get into this, you're excited about this, you can make fixed income your career. It is a great career. I love fixed income. It's got a lot of quant to it. So you can get through the first 200 pages of this book and you would have covered a lot. After that, then they get into specific securities, government bonds, agency, includes just treasuries, agency securities, municipal bonds. There's your tax exempt discussion. Then he gets into corporate bonds, leveraged loans, Convertible securities, remember we skipped those. Structured notes, I mentioned those quickly. That's where you get some bizarre securities. Money market instruments, floating rate securities we didn't talk much about. We did talk about inflation linked. In fact, I've got this chapter signed by Brinjo. That's his nickname, John Brinjo. I can't say his last name, but he's known as Brinjo. But he signed his book for me. He wrote this chapter, and so he sent me just his chapter with his signature. The whole chapter, you might think we covered it, tips. We didn't scratch the surface at all. We covered less than 0.001%. There's a lot there that you can talk about. We did talk about international bonds, but obviously a lot more you can talk there. We talked as well about emerging market debt. We talked about exchange traded funds. Obviously, there are fixed income exchange traded bonds. We did not cover covered bonds at all. We didn't talk about preferred much at all. And then he's going to get into securitized products. This is where your mortgage backs, your asset backed securities, all those things are. And there's several chapters on that. You can see, boy, it gets crazy. Strip mortgage backed securities, just crazy. Commercial mortgage backed securities, credit card asset backed, auto loans, commercial backed, collateralized loan obligations. And then at the very end, he has a whole section on interest rates, interest rate theory, forward rate. We talked about the forward rate. Some of y'all actually, I didn't get into it much, but I have those videos you can watch on the forward rate. He has a whole chapter on that. Yield curve trades, bar bill, bullet, laddered strategies. There's all different types of strategies. And then just talking about your exposure. So they have things called key rate durations and things like that. Just get really, really advanced. Term structural modeling with there's where I talk about the no arbitrage interest rates. And then modeling with embedded option. That's your mortgage-backed securities. Valuation of mortgage-backed securities, how complicated it is, convertible securities. Then he has sections on credit risk. On credit risk, you're really talking about financial analysis. My security analysis class, we do a lot of that. Your 3013 class, you probably did some of that. So you just get into more and more complex stuff, and then they have multi-factor models. I got to work with a few of those in my career. They can get pretty massive, pretty complex things, and just on and on and on and on and on, chapter after chapter. So if remember, you get paid in finance for how much complexity you can handle. If this stuff is appealing to you, you really like the quantitative aspect of this, I'm showing you Fibonacci to let you know there's a lot there. And you don't necessarily have to learn all of Fibonacci. You might just be an expert on structured debt, or you might be an expert on municipals, or you might be an expert on interest rate theory, which would be real important to mortgage-backed securities. So there might be a chapter in here that you go much deeper than Fibonacci goes on the chapter and learn it. It might have to take, and that's why one of the reasons I tell students that you might hold off on a graduate degree for a few years. Figure out where your expertise is going to be, because if you want to do fixed income, you might not want an MBA or an MS in finance. You might actually want a degree in mathematics or a degree in econometrics. The lady who ran the largest bond mutual fund at UTSA had a PhD in math. So it may influence what degree you get, especially applied mathematics. So boy, it just keeps going on and on and on and on and on. So a lot in this book. If you wanted to buy this book just to read those first 200 pages, I would say you could certainly do it. Is it out there as a PDF somewhere on the internet? I'm not going to say anything about that. I don't know what the rules are on that, but you could certainly look for it. So if you don't want to pay the $118 or whatever it is, find an older edition. You can see there's some cheaper ones down here. Not that much cheaper though, but there are some that are slightly cheaper. But I would get the Handbook of Fixed Income. I wouldn't get, this is Introduction to Fixed Income. I wouldn't get that. I would actually get the Handbook of Fixed Income and just find the cheapest version you can get, or maybe 3 or 4 y'all go in together, or try to find it somewhere that you can find it for free on the internet, or whatever your options are. So that's fixed income. It's a great area. To me, it's real exciting. I worked at USAA, so fixed income was extremely important because USAA had about $100 billion in assets, and probably 60%, 70% of those were fixed income because it's an insurance company. There's a lot you can do there. You can make a lot of money doing this. just like you can make a lot of money on the stock side. So think about it. You may not be able to choose. You might say, I want to do fixed income, but if you don't get a job offer there, you won't do that. So your career might pick you. But if you get an offer in fixed income, don't say, wow, I was hoping to get stocks and I got fixed income. I would say go for it. You may be really amazed at what career you can do with fixed income. So I'll stop it there. Next class, we'll start off with the stocks and how to value stocks. I like stocks, but I'm not as excited about them as I am with bonds, but it's still pretty exciting stuff, pretty interesting stuff.